Good morning. I'm Ken Kirschenbaum, as some of you might know, and you should also be able to see Mitch Reitman and his right-hand lady. Well, I don't know, what do you, I am definitely not politically correct. Bart, you don't even have to start, okay? Carol, right?
Yes.
Okay. So today's some of us are stuck home, like me, and although my office is open, so be assured that we are servicing our clients. Today's webinar was, of course, designed before this disaster started. We didn't realize where we would be at this point. So the topic is preparing yourself from a tax perspective for a sale. Tomorrow, by the way, we're going to have Ron Davis presenting on actually doing the sale, and we hope to see you tomorrow. So I've already tapped Mitch for a new another webinar, which we're going to do, dealing with tax issues specifically affected and by this crisis that we're having right now. And we've increased our capacity, so you won't be locked out like our last webinar. And so feel free to have your employees or whoever you think necessary come on to the webinar. So Mitch, I guess it's all you. Eileen's going to switch the screen. There you go. And all that. You got to put your PowerPoint in, and we're ready to go.
Great. Okay. Good morning, everybody. Sorry to be coming to you in the middle of a disaster and a crisis, but we're talking about preparing for a sale of your company and some of the tax items. And a lot of times we will see issues with companies that haven't properly prepared from a tax standpoint, from a business standpoint to sell. And so Carol is here with me. Carol is my tax manager. She was a partner with one of the regional accounting firms here for, she won't want me to tell you, but it's quite a few years. And we run into these issues all the time with companies that haven't prepared for sale and CPAs and accountants that aren't really transactionally based and don't advise people properly. So we want to talk to you about a few things that you need to be looking at, need to be considering before sale. And then we'll take some time out for questions and answers. First thing you need to make sure of, and we're going to talk about that in length this morning, or a minute or so in length, is be the proper legal entity. Also be the proper tax entity. One thing we're seeing people that don't understand lately is make sure you have the proper licensing and insurance. We've had quite a few transactions get hung up because companies weren't properly licensed or didn't have the proper insurance. And sometimes it's completely ruined the transaction, sometimes it's delayed it. The other thing is to make sure, and you hear everybody tell you this, but I'm going to repeat it, is make sure that your monitoring agreements are in good order. This is a great time to call Ken and make sure you've updated your agreements. And if you're planning on selling the next 5 to 10 years, it's a great time to, every time you touch a customer, get them to sign a new monitoring agreement, make sure everything's updated and in order, because whether you like it or not, that's going to be one thing that a buyer's going to look at more than anything else. Make sure if you're performing other services besides just monitoring, inspections, service, anything else, you have agreements for those services. And of course, Ken has a wide range of agreements for those things. Make sure you have them, make sure they're in order, make sure they're signed, make sure everything else is there. The other thing that I see people having an issue with is tracking and managing attrition. And if you aren't doing that now, you need to start doing it, because most buyers are going to look for your attrition over the last 2 years. The last thing is what's your company worth, and that's a whole other seminar. But make sure you understand what your company is truly worth and don't set unreasonable expectations. So first thing we're going to talk about here is type of entity. And the two most prevalent types of entity, and the type you should have at least, is a corporation or an LLC. I prefer the corporation. There's a lot less paperwork. Some people do LLCs, and I'll talk a little bit in a minute about why those aren't always the best idea. What you don't want is a sole proprietorship or general partnership where you're not limiting your liability. Those are legal issues, and Ken can talk to you about that. But if you're a sole proprietorship, it's time to start looking at incorporating. Now, corporations are two different types. There's what is called an S corporation. The S originally stood for small business, and a C corporation. An S C corporation is what you see, a large company that has thousands and thousands of shareholders, has foreign shareholders, has other companies as shareholders. That's the entity that General Motors needs to operate at. That's the entity that large companies that are publicly held need to operate as. For a small company, and by small, I say less than 100 shareholders, an S corporation is your best vehicle. And we'll talk a little bit about that later. An S corporation and a C corporation are the same from a legal standpoint. The differentiation comes from the IRS. The IRS treats S corporations differently. Now, a lot of people are forming LLCs, and that's fine, but LLCs are not recognized by the IRS. And what that means is there's no tax form for an LLC. So an LLC either has to be a corporation, it can be an S or it can be a C, it can be a partnership, but a partnership obviously has to have at least 2 members. Partnership can't be owned by one person. In that case, it's a sole proprietorship. The reason why I don't like LLCs that are sole proprietorships is that unless you elect to be taxed as a corporation, your tax information has to go on your personal tax return, your Schedule C. And I don't know how many of you have been audited, but when you're audited, the first thing the IRS does is ask you for your bank tax returns and for your current tax return. If you are a corporation, whether an S or C, you have a separate tax return. It's not on your personal tax return. All you have to do is send them that. If you are a sole proprietorship or LLC that's taxed as a sole proprietorship, you have to send them your personal tax return, and that launches a fishing expedition like you won't believe. So the best entity to be incorporated as, to do business as, is a corporation that's selected for S corporation treatment. If you want to do an LLC, then an S corporation is your best vehicle as far as electing.
Mitch, I just want to add one thing. I fully concur that you are best off with a subchapter S corporation. From a legal standpoint, I can tell you that corporations have been around there are some uncertainty or novel issues as they pertain to an LLC that would be well settled with a corporation, with an S corporation. I am baffled why every single accountant asks for an LLC. I get clients calling me, need an LLC. Why do you need an LLC? My accountant told me to form an LLC. Okay, well, first of all, and this should help dissuade you, an LLC costs $1,800, $2,000 to form. Corporation, $500, $600, $700 maybe. Why? LLCs require, at least in New York, and Mitch might know other places, in New York, you're required to publish your formation of the LLC. So that's a publication cost. You're also required to have an operating agreement. That's another expense you have to go through. That's the equivalent of a shareholders agreement, although it's a lot more complicated because in an operating LLC operating agreement, you're really trying to have a managing partner and everyone else as somewhat of a limited partner. So when you end up having 2, 3, or more equal partners, that plays out much easier in a subchapter S shareholders agreement than it does in an operating agreement. So that's my take on it. Subchapter S, I agree with Mitch 100%. Mitch, back to you.
And let me reinforce a little bit about what Ken just said about an explanation of why some CPAs suggest an LLC. It's slightly less expensive to file your tax return because everything gets filed on your personal return. But on the other side of the coin, if you get audited,
that's only if you're a single owner, by the way, right?
I'm going to get only if you're a single owner,
right.
Which most people are. But if you get audited, and that's starting to be more and more prevalent now, the IRS, the new tax code freed up thousands of agents that were out chasing around painters and subcontractors for their $700 insurance payment. and it got rid of all the people that were itemizing their old clothes they gave to charity and their old beat up car they donated to charity. So those auditors are looking for stuff to do. And what are they looking at? They're looking at auditing people that have businesses. And if they pull your Schedule C from your personal return for your LLC to be audited, they've got your personal tax return. So that's it. That way outweighs any extra expense. The other thing is, the other way that an LLC can be taxed, if it's not a corporation, is as a partnership. The IRS is very concerned, and I had an IRS examiner tell me one time, they pretty much believe that every partnership in the country is some sort of tax sham. And so your chances of being audited as a partnership are much higher than being audited as an S corporation. And that's another issue. The only reason I can see to form an LLC as opposed to an S corporation is two of the requirements for S corporations is that all the shareholders have to be human beings. So if you have a corporation or a hedge fund or somebody like that investing in you, which I see maybe 0.1% of the time, then you'd have to go with an LLC. Or if you have a non-US citizen that isn't authorized to work in the US, they can't be the shareholder in an S corporation. And I've seen that in over 1,000 tax returns one time. We have a client who's from Canada, and he's authorized to work here. His wife is a 49% shareholder, and she's not, and so they have to form an LLC. Other than that, I've never seen any reason for these LLCs to be formed as an LLC. So Ken is right. It's much more expensive in the long run and much more dangerous. But I want to get back to the difference between an S corporation and a C corporation. This is one thing a lot of accountants, a lot of tax advisors that don't know the industry, that aren't transactionally based, that they just don't understand. And that's when you go to sell your company, what the taxes are going to be. So let's go back and consider an S corporation. S corporations are what they call pass-through entities, which means all the earnings of an S corporation are allocated amongst your shareholders, and the shareholders pay the tax in their personal income tax. So if you're a 60% shareholder and the other guy's a 40% shareholder, you make $100,000. You pay tax on your personal income on $60,000, and they pay tax on $40,000. Most accountants that don't understand the industry think, well, why not have a C corporation? We'll just bonus all the extra money out of his income at the end of the year, and nobody's got to pay tax, or we can pay 21% tax and hold stuff in the corporation. What they don't know is you've got this huge intangible asset that's not on your balance sheet, not apparent to anybody, and when you go to sell it, you're going to pay tax on it. And in this case, your asset is your RMR. So here's an example of a good-sized company. It's a guy with, let's say, 800 or 900 customers. He's got 30,000 of RMR. He sells his company for $1 million. That sounds like a lot of money, but maybe this guy's 63, 64 years old. He's going to have to live on that for another 25 years. So an S corporation, that all those gains will flow through to as capital gains, so to an asset sale, to his personal tax return. He'll pay tax of $175,700. He ends up with $824,300, and he's done. There could be some state tax, but pretty much he's done. It's over. C corporation pays tax at this very low corporate rate of 21%. So the C corporation pays $210,000 of the tax. And then when the owner goes to take the money out of the C corporation, it's now a dividend. And he has to pay tax on ordinary income, which is earned income, on the dividend, and mostly at 37%. But there's even another catch. What they call the Obamacare tax. So it passed about 6 years ago. It taxes people whose only income or whose majority income is from capital gains at another 3.7%. And so they have to pay another 3.7% of that because the stock in the company and the dividends in the company weren't used for business purposes. So now they have to pay another $346,000 in ordinary income tax. So they'll have to $443,000. So by virtue of the fact that they weren't an S corporation, they paid almost $400,000 more, almost 4 times as much tax on the sale. That is why you need to be an S corporation. If your accountant doesn't agree, you need to talk to them and understand why they don't agree, or find another accountant. So other considerations. When you sell, let's look back at this company with $1 million gain. The capital gains rate on the first 15% on the first $488,000 of total income is only taxed at 15%. So that would actually be even less. And one thing you may want to consider is if your company's worth about $1 million, is breaking the transaction over 2 years. That's one thing that's really nice you can do with an S corporation to pay some less money. The other thing that happens in these transactions is ordinary income that comes from certain aspects of the sale, which is something you need to consider before you enter into the purchase agreement. And that's something that a lot of accountants don't understand, a lot of accountants don't prepare for, but something you need to understand before you go into the process of selling and doing your purchase agreement. The IRS tracks us on what's called a Form 8594. And the 8594 has to be agreed to by the buyer and seller, and it breaks the assets into 7 classes. Some are capital gains and some are ordinary income. What that means is when you sell your company, you're not just selling RMR. You're probably going to sell some vehicles, you're probably going to sell inventory, you're probably going to sell some fixed assets and desks and furniture and stuff like that. How you allocate the sell to those classes depends on what's going to be taxed as ordinary income and what's going to be taxed as capital gains. And it's a complicated situation. It's something you should do one-on-one with your accountant or call us. We're not going to get too far into it right now, but I'm going to show you a very simple explanation of depreciation recapture. And what we have here is a truck that you originally paid $32,000 for, and you've taken depreciation over the years of $17,000. That means on your books, that truck has a net book value of $15,000. If you sell it for $20,000, the IRS is going to make you what they call recapture $5,000 of that depreciation. You took it in prior years, you got a deduction for it. They want you to pay that $5,000 back at ordinary income. Let's say you sold it for $12,000, you have a $3,000 capital loss. You can actually take that loss against your gain on the sale of the accounts. So how you value these assets is very critical. We just went through one where they had about 40 trucks, and we saw this coming over the horizon. Their attorney called us and said, you know, we want you to take a look at the tax aspects of this. And we put into the purchase agreement that the 8594 had to be agreed to before the purchase agreement was signed, and that all the vehicles were going to be valued at Edmunds wholesale value, which ended up being $85,000 less than if they would have done them at retail value. And of course, after the transaction happened and the buyer tried to put them on their books, they wanted to put them on a retail value. And we said, wait a second, go back and look here on page 27 of the purchase agreement. You agreed to wholesale value. So it's very important to get things sewn up before you prepare the purchase agreement, before you close the transaction, because there are lots of line items that can get you in trouble. That is the end of the formal presentation. I want to talk to you a little bit, just very shortly, about what you're hearing from Congress about how they're reacting to the pandemic and what they've said. You probably heard from the news, and there's a lot of misinformation, but now it's gotten straightened out, that you have until July 15th to file all your tax returns and to pay your taxes, and that is now correct. It was at one time you had a while before you had to file extensions and file returns, but you had to pay your taxes. You can now wait until July 15th to pay your taxes. What they're not telling you is that the states have not issued, no state that I'm aware of has issued any kind of extension or anything else. Now, most states are typically due April 15th or May 15th, and what we think is they're waiting to see what the IRS finally decides, which they finally decided over the weekend, as far as requirements, and they will have their own individual requirements. But you need to be very careful if you're thinking about taking more time to file your tax returns, that you find out what your state is doing, because if you get an extension for federal purposes and your state doesn't allow a state extension, you could end up with penalties and interest by the fact that you didn't file the extension, because you can't file an extension late. If an extension is due, let's say on May 15th, and you don't file the extension, your return is now late. And if you file the extension on June 1st, it doesn't matter. You didn't file the extension late. There's no late extension. So the clock on penalties and interest starts clicking until the day you file that return. Now, I think the states are going to come up with policies and procedures on that. I'll either be updating that through webinars that Ken's going to do, or on Ken's daily email. For example, if Iowa says you have an extra 60 days to file your return, we're going to put out a short notice on Ken's website. But if something major comes out of the IRS or something important comes from legislatures or Congress, we'll have another webinar. And Kim mentioned earlier, he's got up to 500 people that can be on that, and we'll do it. And we're out there to help you. We're out there to be a resource for you and out there to work with you. Okay, Ken, that's the end of the formal presentation. I know we went through it kind of quickly, but I'm sure there are plenty of questions out there, so we're ready to answer.
It's okay because everybody's got a lot of things to do, like go look for toilet paper wherever they can find it. So you know, we are gonna have a webinar on that maybe.
Yeah, the toilet paper market of 2020, the people that invested early are going to make out like kings.
There's a lot of people making a lot of money right now. I can tell you that.
I can tell you, some people will be going to jail for selling toilet paper for $500 a roll and stuff like that, and I hope they do.
Yes, I hope they do too. What happened to my questions? Oh, here we go. For a small company, how would we track attrition and document historically? We are not currently doing anything formal.
The easiest way to track attrition is to do what's called an RMR roll forward. An RMR roll forward starts with your RMR at the beginning of the month. It adds your installations, price increases, anything that increases your RMR. It subtracts your cancellations, price decreases, anything that decreases RMR, and comes up with an ending number. And what you do is each month you compare the beginning and the ending, and that's your monthly, and divide how many cancellations you have by the beginning and ending. That's your attrition. One common misconception is that adding a new account, going out selling a new account does not reduce your attrition. A lot of people are confused on that. So if you have 100 accounts and you lose 5 and you add 3, your attrition is not 2%, your attrition is 5%. Adding new accounts does not affect your attrition. The only changes besides cancellations and additions that do affect attrition is what we call rehooks. The customer moves and reconnects at the new location. The customer leaves, but you get the new owner of the premises assigned. That is an item called net attrition, which is an adjustment you can make to gross attrition. But the easy way to do this, if you don't have the software that does it, like Sedona or MicroKey or one of the more advanced softwares, is just set up a spreadsheet every month, put those numbers in there, and run a formula and print that. It's very important to know what the smarter companies do is they find out why people are canceling. They died, they moved, they ran out of money, they had coronavirus, they had whatever it is, and they start tracking those and looking for things that they can address. Because if you can address that attrition, one, it brings down your attrition, but two, it makes a buyer see that you are concerned about your attrition and gives you more value in your company. Does that answer the question?
Oh, I guess so.
Okay.
I want to just mention, by the way, that my firm's collection department is operating. If you have our contracts, we will support you because there's an arbitration provision in it that we're able to utilize. So we're able to handle cases from all over the country, at least through the arbitration process. Let's get back to Mitch's topic, though. Do you think this COVID issue will affect the price of multiples of companies? Well, probably Ron Davis is going to be ready to answer that. Mitch, what do you think?
I'm sure Ron will talk about that. There are multiple factors out there right now. The COVID is obviously going to have an effect. There are going to be some companies that were already struggling, and this virus issue was the last straw that broke the camel's back. And that's going to cause a lot of companies to want to sell. But one thing that's been happening for about 6 to 8 months is 2 of the large residential aggregators have had some serious issues. The banks have, 2 banks have pulled out of the industry because of the issues that they have with some of these large residential aggregators. And there are a lot of residential accounts right now on the market for sale at very low prices. So that's causing 2 things. One is people are seeing residential multiples go down. Commercial accounts still have value, but residential accounts are having issues not because residential accounts are necessarily bad, but because these companies are now liquidating and they're having to sell at low prices to pay off their bank loans. The other thing is that people are concerned about DIY encroaching into the residential market. I'm not that worried about it, but it is causing some spikes in attrition. So whether it's realistic or not, there's concern. And the third thing is, because there's so many residential accounts flooding the market right now for sale, the larger buyers, ADT, ADS, ACA, some of these people are looking for good bargains on residential RMR that's for sale sometimes in the high 20s. And the advantage they have is a lot of this residential portfolio got into trouble because the owners couldn't service it. they were based, let's say, in on the East Coast, and the portfolio was on the West Coast. They were counting on dealers to service it, and the dealers didn't service it. And now they're having problems getting service done, and attrition spiking. The banks are saying you need to sell that. These companies that are buying, the ADTs of the world and the Brinks of the world and people like that, they have service branches out there where they can provide service. So they're getting what was troubled portfolio, and they're able to service it, and they're getting some bargains. So there are less buyers out there right now if you're selling a traditional company. So that's going to be an issue. COVID is going to cause some issues, but I think there's some opportunities in there to service your customers, take care of them, and pull through this.
I think there were a couple of issues, including banks tightening in this market, in the alarm acquisition market. So I think that's coming. That's an issue. I think this COVID-19 issue is just maybe it's made it worse, or maybe it's a reason for blaming somebody. Ron will probably hopefully be able to comment about what he sees in terms of offers. Don't forget the demand from the seller is pretty much the same. So I know that I have not changed the market that passes through me. So those sellers that call me, one of my first questions is if they have my contract, and if they do, if it's an up-to-date one, I say our starting point is 35 times. Okay, and that's what I let potential buyers know. This product is company is 35, 36, 37 times. Fire maybe even a little bit more. The bigger type those are for company to company sales, as opposed to selling to these bigger operations that are out there looking to buy. Let's get back to some questions for Mitch. How many years back does due diligence go typically for RMR numbers?
Typically 2 to 3 years. They want to see your attrition over the last 2 years at least, and they want to see your financial statement for the last 2 to 3 years, bank statements, things that support your transactions. People ask me, why do they want to look at all this stuff if you're only selling your accounts? That's the biggest question I get from sellers. And the reason why is, if you say you have $30,000 of RMR, I want to look at your bank statements to see if you have $350,000 to $400,000 a year of deposits. If you don't, I'm starting to question your RMR. I want to see your attrition. I want to see your cancellation rates. I want to see your billing histories. We worked on a transaction, a huge transaction a couple years ago, where almost 30% of the customers hadn't paid, some in over a year, and the company's just issuing credits. So we went back and looked for 24 to 36 months of payment histories and found issues. And the deal still happened. It caused an adjustment to the price, but it kept my client from way overpaying for it. So for due diligence, 2 to 3 years, we advise our clients to at least keep 7 years of records. The IRS can go back 3 years for most issues, 5 years for other issues, but it's always nice to have 7 years of records around. You never know what's going to happen, and the attorneys can talk more about that. But once you shred it and throw it away, it's gone, and it's going to be really hard to replace.
Here's another one. How can an LLC sell its monitoring contracts only and not the LLC?
It's just a pure asset sale. The LLC can do an asset sale. Hopefully the LLC is elected to be taxed as an S corporation. Hopefully not as a partnership or proprietorship, but that would work also. If it's an asset sale, the tax aspects are exactly the same as I showed for the S corporation here, as long as it's elected to be taxed that way. If it's a C corporation, if it's taxed as a C corporation, you run the same issues and the same problem with, once you convert to be an S corporation, you have to wait 5 years to sell the assets without incurring the double taxation.
So actually, an LLC sells the same way as a corporation. It's an asset purchase deal, right?
If it elected to be taxed as a non-taxable entity, because remember we talked about LLCs aren't recognized by the IRS. There is no LLC according to the IRS, so you have to fill out paperwork to elect the way you want to be taxed. And what you've done when you form the LLC is going to control how your taxation gets treated. So hopefully you've done it right and you sell as an asset sale.
Okay. Someone's complaining that they can see the bed behind me. I won't say who. The usual pain in the neck, but I won't say who. So do you think there is still financing available if we wanted to buy accounts? Yeah, by the way, the answer to that is, and I'll give him a plug, the answer is yes. Jim Worcester is out there still. I forgot the name of his company. He's listed on in the Alarm Exchange. They are still funding relatively small deals. So that's one source. Mitch, you can answer that though.
The words right out of my mouth. Jim Wooster at AFS is a creditable, ethical, great guy. He's a little bit more expensive than a bank, but the bank isn't an option right now. I'll tell you why in a second. His company is Alarm Financial Services. They're on the exchange. Call him. He'll do a good deal for you. The interest rate is going to be a little higher than a bank, but if it's a good transaction, you'll be glad you did it. The reason why it's hard to find money from a bank right now is two banks have pulled out of the industry. And so several large borrowers have gone to one of the other three banks that are still in the industry, but they're very backed up for writing new deals. And if they're working on a $40 or $50 million loan that they're refinancing from one of the banks that have pulled out, and you show up looking for $3 million, you're not going to get a lot of priority. If you're looking for less than $3 to $5 million, you're not going to get the attention from one of the industry banks. They don't need that business right now. The only option you have besides Jim is to go and talk to your local bank. And what you're going to run into there is they don't understand the industry. They don't know what you're buying. They can't figure it out. So you're borrowing purely on your reputation and the feeling that that banker has about you, which usually is good for $250,000 to $300,000. When you get
wait, Mitch, wait. You don't know our audience. You can also they're not just going to loan based on your reputation. They're going to loan based on your house and other collateral that they're going to insist on, and which means you're gambling on your purchase to make sure it's going to pay off in the long run.
Well, that was the next part of my comment. Yes, they're looking at your house, looking at your assets, if you have stock, securities, money put away. They're looking at your personal financial statements, your personal reputation, your personal credit. And unless you're just incredibly wealthy with millions of dollars in the bank, in which case you ought to just liquidate some of that stock portfolio that's nosediving and use that to buy the company, you're going to have a hard time getting past $250,000 to $300,000, because at that point, most bankers have exhausted what they call their discretionary lending limit, which means they can make this loan. Nobody's really going to question it. They can paper it themselves and send out the door. When they get up to $500,000, $700,000, they've got to get some other people to buy in on it, and that's much, much harder to do. So that's why Jim Wooster has such a good deal, because he's convinced the banks, a large bank, that he knows how to tell a good deal from a bad deal and good credit from bad credit. He's made hundreds of loans that perform very well, and so the banks loan him the money, which he turns around and relends it, and just like anything else, he's going to mark it up a little bit, but the reporting requirements for Jim are much less stringent. You don't need reviewed financial statements. You don't need monthly reports. You don't need stuff like that. What he's going to charge you in interest, you're going to save 2 or 3 times over and not having to have the reporting and the financial staff.
This is a crisis issue question. When should alarm companies consider layoffs rather than depleting cash? That would be unique to any business, I suppose, but
from the guidance I'm getting from the AICPA is there's going to be some provisions in this tax bill to do 2 things. One is, if you have to pay salaries to people that are sick and can't work, you're going to be able to take a dollar for dollar tax credit. Now, this isn't formal yet, but they're saying this is probably what's going to happen. Take a dollar for dollar tax credit against your taxes next year. So if you owe $40,000 in taxes and you pay $15,000 out to your employees, you get a $15,000 credit. Now, some companies can't make it until then. And so there's also some talk, and of course this is going to be in the bill, but it's going to be interesting to see how it gets administered, that if you can't make it until next year, you get your tax credit, that loans will be available from the Small Business Administration to tide you over until you get your tax credit. It's going to be a lot of paperwork, it's going to be complicated, and it's not going to be easy. But one thing to remember is that the world isn't ending, things aren't over. What they're trying to do is get everybody just to stay home, quit riding the train, quit riding the subway, quit riding the bus, stay away from each other for a couple of weeks. Let's what they call flatten the curve, stop this spread of the virus, and sit still for a while. I think in a couple of weeks, if we all pay attention, that will be over. one thing you need to do from an operational standpoint is limit your service calls. If somebody's alarm isn't working, then yes, you should probably go out and make that service call. If somebody's asking to add a Ring doorbell, you may want to say, hey, why don't we do that in April? But if you can hold through this, what we're doing here is I've told all my employees, they don't have to come to work. We're exempted if they do put us on lockdown in our county, because for some reasons I won't get into, accounting firms have been exempted, but we also support the security industry, and any security company is exempted. Your employees are allowed to travel into work and come to work for you regardless of the lockdown. But I've told my employees, if they feel uncomfortable, they don't want to do it, they want to stay home, fill out a timesheet, I'll pay you, and we'll work it out later. And that's probably at this point the best thing you can tell your employees, because you don't want to have to go out and hire new employees 2 or 3 weeks from now.
Does anyone want to contribute anything? There's a way to put your hand up, I think, or maybe hit question, and I'll unmute you if you want to speak to the group. You want to raise any issues or make any comments? So I'll give you a chance to do that while we wait to see if there's any other questions. Someone just wanted to confirm that 7 years of records have to be maintained. That's an IRS look back period, I suppose.
I didn't say have to. The IRS is 3 and 5 years, but I'm a better safe than sorry kind of guy. I tell everybody 7. That outruns. The attorneys have told me, and Ken, you can jump in there. The attorneys have told me that most statutes limitations run out at 5. So I added an extra year to 6, an extra year for fudge factor. Said keep 7 years of records. You can shred them after 7 years, but once you've shredded them, you can't get them back. So don't do it at 3 years.
Here's some scary information. Okay, first I'll start with a question. So you are unlucky enough to have an audit, and the question comes up, show me your records. And your answer is, well, I don't have my records. Our policy is to keep them for 3 years or 5 years, and the IRS says, well, we want to see them for 7 years, and you don't have them, and you say, well, I don't have them, and then you tell the IRS, well, I don't have them. So now the question is, what's your problem at that point? And here's the problem. We're all used to criminal law and watching it on TV or hearing about it, and innocent until proven guilty. Mitch, I would want you to confirm what my information is. IRS is a little different. You're guilty until proven innocent. So when they start asking for records, you're the one that needs to find them. If you're going to try and prove that you don't owe the tax, it's going to be your obligation. So wait, just before I do that, one question came in. This is not necessary for you. Alarm companies are essential in New York City, and all over the country. That's federal as well as state. So you are essential. You can work. So that answers that question. Okay.
To go back to your question, I want to say, one, you're absolutely right, but the way the IRS has gotten around the Constitution with that is that they've said the taxpayer has the burden of proof, which doesn't say you're guilty until you're proven innocent, but it does say until you prove you're innocent, you're guilty. So it's semantics, and you're absolutely right. Taxpayer has the burden of proof, but let me kind of tell you a little bit about the way an audit works. They select somebody for an audit. It could be because they think you're a crook, but it could be just because something looked out of the ordinary. Your income spiked a lot in a year, you had a big capital gain, you had something like that. They want to get an idea of what's going on. What I tell my clients is the way you win an audit is documentation. So what'll happen is IRS agent will call you and or send you a letter, and you'll call me, and I'll get a hold of the IRS agent and say, come on over to my office. A lot of times I'll reassign it to somebody local here, and the guy will come out, has no idea what he's looking for, no idea what's going on. We'll sit down here in my conference room, big, comfortable, comfy chair, and I'll start asking questions about the tax return. If it's my client, I can answer his questions right then and there, right across the conference table, because I've got all the documentation that they've never seen before that we collected when we did the tax return. And they'll ask me some questions. I'll give them the answers that they want to hear. They'll realize that there's nothing hokey going on, that there's substance behind every number on the tax return. They'll go have a big lunch. They'll call in and say, we're done. And they'll come back and see me at 2 or 3 in the afternoon and leave. If you're sitting there bumbling and you can't find records and you can't give them answers, and you can't tell them what a number means in a tax return, one, they're going to call and make hotel reservations for the next 2 weeks. They're going to be out here for a while. And two, they're going to start a fishing expedition. They're going to see what else can we find and what else can we ask for? What else can we look at and spread it into multiple years? So you want to, one, make sure you document every line on a tax return with real numbers and invoices and records. And two, you want to make sure you can find those records. And I've never seen anybody go back more than 5 or 6 years unless there was fraud. And if you're committing fraud, I don't want anything to do with you. And if you got 7 years of records, it's going to take a little bit of extra space, throw them in a banker's box at a rental place, and let them sit there and shred them after 7 years. But you can't unshred these records once you shredded them.
Well, we have a comment that it's not against the law to recreate the records, which is fine, except you might find yourself really spending an awful lot of time trying to do that. Yeah, that's the point. If you don't save your bank records, yes, they might be available from your bank, but you're the one that's going to have to get it. You're the one that's going to have to pay your bank to reproduce it. You're not going to be able to just say to the IRS, "Here, you go find it." That's the point.
It's a battle and it's a game, and nothing's better than when the IRS agent asks me for something and I turn around, open a box, and pull out the piece of paper he's looking for and put it down the conference table. If you have to say, well, I need to call my bank and I need to get records, I need to call the vendor, I need to do this, I need to do that, pretty much count on not being able to run your alarm company the next 3 or 4 weeks because you'll be working for the IRS.
Another comment, I guess a question, don't audits usually go back 2-3 years, and only if they suspect criminality will they go further or deeper into the investigation?
Well, I'm going to let Carol opine on that a little bit. One thing I will say is there are certain things like basis and assets and building gains issues and C to S corporation changes that do go back more than 3 years, and the IRS does want to see that. That's something to make sure your accountant is advising you on. Carol, can you talk about any other things that go back more than 3 years?
It's my understanding on their checklist, they're either going to go back one or the next year forward. So they're going to go one way or the other. That's on their checklist.
And one thing to make sure of too is make sure that your accountant has the IRS audit guides. They're public information. We pay for a service that shows them. When an IRS agent goes out to do an audit, they grab their guide there in their office and pull that out, and it says this is what we're going to look at. If your accountant doesn't have that, when we've only had 2 clients audited in 17 years. We've gotten quite a few that somebody screwed up or somebody did their tax return, somebody did something that come to us now to represent them in an audit. We pull the audit guide out, so I already know before the guy sets foot in my building what he's looking for. And I know the things that he's looking for, building gains issues, basis and assets, things like that could go back 6 or 7 or 8 years. And we make sure that we've got all that stuff. And one thing we know is that we have a client that has exposure with something like that could go back 7 or 9 years. We tell them, hang on to these records, these particular records for 9 or 10 years, because those are very hard to reconstruct, and those will get you in a lot of trouble.
Okay, we got, how can I tell employees to just not come in if we're small, and that would almost put us out of business? I need people to show up. Looking forward for more information on how I could still pay them if they stay home. Well, I'm not sure where you're located, but there's unemployment benefits. If you're in New York, there's family leave benefits. Other states may have other kind of benefits that come available. You're required to pay your employees their sick time, but unless you have employees that are locked in with contracts, you can terminate them. So that's what's happening. But keep in mind, you're an essential business. You can stay open. Your customers are depending on you. So you have a right to be open, and your customers should continue to be paying you. I hope you've all by now switch to credit cards because that's what needs to be processed at this point. Mitch, you have anything you want to add to that one?
Going back to what I said a little while ago, the whole idea behind this is to shut everybody down for 2 weeks, get them off the trains, off the subways, off of everything else. They're non-essential employees. Look at your employees and see who's essential. Your installers, your techs are essential. Some of your people may not be essential, but do what you can to pay these people. I told all my employees this morning, I said, we're not on lockdown yet. If you feel uncomfortable, stay home. If you don't, come in. Nobody yet has said they're not going to come in. Everybody's going to come in. I'm going to keep paying them. But if they want to stay home, I'll keep paying them too, because it takes me 3 or 4 months to hire somebody. I don't want to go through that with 7 employees. And a small company, I know it's a big burden. You're most certainly going to get a tax credit from Congress. There most certainly going to be some ways to get money from the SBA. Advance on a credit card, refinance your car, get a second mortgage, do something. My advice is try to keep paying your employees because they're critical to your business, and this will all be over hopefully in a few weeks.
Well, we're gonna have a separate webinar on that with Mitch as soon as we have a little bit more information about what relief may be available to business owners. Back to taxes. On tax credits, aren't we going to be able to take that on payroll tax side this year? There's no point answering that yet because we don't know the answer. Let's wait to see what gets enacted. Okay.
There's some rumors
speculating.
But there's some rumors out there. I think it's going to be credit on your actual income tax next year. But let's
right, but let's not give out any information that's not solid yet.
Don't start rumors yet, guys.
With an S corp, what's the best way to sell your RMR accounts with the least tax burden? Well, I know from a liability standpoint, it's an asset purchase agreement. Mitch, what you have a
Absolutely. Asset sale is a way to sell assets out of an S corporation. It's cleaner. You're going to get the best price. There's no tax detriment either way. And what a lot of accountants don't realize is if you sell the stock of an S corporation, then you're liable for that 3.7% Medicare tax because the stock is not an asset that's used in your trade or business where the contracts are. So sell your contracts, sell your vehicles, sell your inventory, sell your fixed assets. So whatever the buyer wants, sell in an asset sale. You're not going to get dinged for that double taxation if it's an S corporation that is not subject to building gains.
Well, let me just give a real life situation. We sold a company a week or 2 ago that was an S corp, and we actually sold the corporation. Why? The reason why was that the buyer was a longtime employee of the company, was comfortable taking over the company, was not really a business person in the sense that he was prepared to set up a business, get the accounting going, get the books going, get the insurance in place, get the contracts in place. He really wanted an ongoing operation, which he was able to do by taking over the S corp. He also, of course, was comfortable that the S corp had been operated in a proper fashion and that there weren't any outstanding liabilities or tax issues or anything like that. But how is that going to be taxed, Mitch, that sale? The owner got a certain amount of money for selling the S corp. I assumed that it would wind up being a capital gains a tax that they would be subject to. Was I wrong? I didn't give tax advice, by the way, but that's what I thought.
You're correct that it's going to be capital gains, and the reason why is that he sold the stock of the company. The seller sold the stock to the individual buyer, and that was a capital transaction to sell a stock. What they're going to run into an issue with there is that 3.7% Medicaid tax, because if you don't use the asset that you buy in the trade or business, then you're subject to that 3.7% tax. When you sell RMR, you use those contracts in your trade or business, use the vehicles in your trade or business, use the inventory in your trade or business, so you don't have to pay that 3.7% tax. you don't use the stock in your traded business. But here's the issue for the buyer is if you buy an asset sale, and let's say you buy $30,000 of RMR for $1 million, you can put that $1 million on your books in an asset sale and amortize it over 15 years. So every year you get about a $70,000 tax deduction. If you buy the stock, there is no asset to put on your books, so the buyer gets no tax deduction for those 15 years.
You mean that it gets no depreciation?
It's amortization on an intangible, is what you call it, an intangible asset, amortization, same as depreciation. So you don't get that depreciation, which if you're borrowing money from a bank can be very critical. What I might have suggested if I would have seen it early on, but of course I'm not that familiar with the transaction, is to bifurcate the transaction and to sell the assets for 90% of the purchase price and sell the corporate stock for 10% of the purchase price in 2 transactions. So you get that asset, that RMR, to put on your books and amortize, and then the buyer gets the corporation but only pays 10% of the purchase price for that, and then everything transfers over. But I'm sure there were some details. I'm sure the accountants looked at it fairly carefully, and so I don't really want to get into a transaction I wasn't involved in.
Well, the buyer, of course, in the situation I'm describing, of course, gets to retain whatever depreciation basis the seller had. So whatever the corporation had, he retains it.
Well, the problem is though, Ken, those contracts, since the seller self-generated them, they have no basis. There is no amortization basis in them.
Right.
So he can take the amortization of those contracts, but it was a case I wasn't involved in. There could be some extenuating circumstances. I'm sure their accountants looked at it, but that is not typically the way you sell assets out of an S corporation.
Is goodwill depreciable? I didn't think so.
Goodwill is amortizable. Goodwill is the excess that you pay over the value of the assets. That only comes into play in an asset transaction. But in this industry, I hear CPAs that don't understand the industry all the time say, what about the goodwill? If you sell $30,000 of RMR for $1 million, that RMR is worth $1 million. It's not worth 600,000. It's not worth 200,000. It's worth $1 million. So there is no asset, there is no excess of the purchase price over the basis of the value of the assets. The assets are what you sold. The only time you see goodwill is sometimes we'll see an integrator sell, and their ongoing earnings have some value, and those aren't contracted, and that results in goodwill, and you can amortize that over 15 years. That was something that changed, Ken, about 15, 20 years ago. For years, goodwill wasn't amortizable, so people tried to push everything into other assets.
Here's a question. I think maybe we answered it. While purchasing, is it better to buy accounts or the entire company?
Better to buy in most cases, better to buy just the accounts. For legal reasons, but also for accounting reasons, you need that asset to put on your books and amortize.
Right. Okay. So here's a comment about what we were discussing, a little off topic of taxes, but it says you can stay open. Customers may not let you in the building, or sales may go flat, and you have nowhere to send installers. Well, that might be the case, but I know that other guys are more concerned. I've gotten a number of requests. Do they need a release from the customer before sending in a tech? I said no, I didn't think so, and I don't think that you can ask your customer. Your customer might want to ask you for a release just as well. Everyone needs to just be careful. I think that was my answer, but that's not a tax question.
And social distancing is say 6 feet away from each other. Just everybody stay 6 feet away from each other. You'll be fine. Just when you go to your customer's house, just stay 6 feet away from them.
Yeah.
Your hands don't hug, don't anything else. Don't run.
How has been working in the business? He has been working in the business for a number of years. However, he is more a technician than owner without training. Are there any special tax ways to transfer an S corp to a relative's son? A relative, in this case, his son.
That's a whole seminar. Obviously, if you can gift it to them, that's a whole other seminar, and do it that way. But if it's not something that's giftable and not something that falls under the gift tax provisions, there's going to be a taxable event. But every case stands on its own. That's a whole other seminar. That's something that can be done, but that's something we need to get. It's probably a joint thing with either Ken or us or Chester Brzezinski, who's a tax attorney that's in our practice. that can explain to you that, but it's not a one-size-fits-all thing. It's very complicated.
All right, Mitch, I'll tell you what, since I'm sitting at home looking for webinars to do, let me know when we can schedule that, and we'll blast that one out. Transitioning to a relative, that'll be what we call it from a tax perspective. Okay. How do you document RMR accounts as an asset instead of just inputting revenue as standard income?
Well, the accounting rules require that you have that if you didn't pay anything for the asset, you can't put it on your balance sheet. Assets have to be on your balance sheet at cost. The only way, well, there are two ways around that. One is to amortize or capitalize your creation costs. So if it costs you 18 times the RMR to put the account in, you can put it on your books at 18 times the RMR and amortize it. But you got to do that for tax purposes, and it's going to cause your income to go up for tax purposes. The other way to do it, and the best way to do it, is to do what's called a pro forma statement that is not part of your financial statements, that you have, make sure your accountant understands what you're doing. It has all kinds of disclaimers on it that if you went to sell these accounts, this is what they're going to be worth. They can't be a financial statement. They can't be included on your balance sheet. You can run a schedule and say, look, this is what these are worth. This is what I could sell them for. But I see a lot of this. There are a couple of Facebook groups where owners are talking about how to show these. You can't estimate the value of something in a sell and put it on your balance sheet. Even certain securities you can't put on there until you sell them. You've got to carry them at the historical cost. If you bought a Maserati for your company car and it became highly traded and highly valuable and the value went up by $50,000, you can't just add $50,000 to the value of that Maserati on your books. You just can't do it. There is no way to put an asset on your books for more than you paid for it.
So Mitch was being overly kind, suggesting that you talk to your accountant, but I think he was sending you in the wrong direction. You need to talk to Mitch. You guys in the alarm industry, this is the guy for you. This is the accountant and tax advisor you should be using. Okay? I mean, hands down. No other accountant has the experience in this industry and the infrastructure that he has. Okay? Simple as that. And he did not pay me to make that statement, although I might send him a bill for it anyway.
I couldn't afford to pay him to make that statement. I need more time.
How is the basis handled on accounts that I just purchased years ago and have been depreciated? Your basis is zero, man. You know the answer, right?
Well, no, if you purchase them and you've been amortizing over the years,
yeah.
What I suggest doing is you pool those assets. So if you purchase some in 2009, you purchase some more in 2012, you put those into pools. And what I mean by pools is, so you've got this $10,000 of RMR you bought for $300,000 in 2009. It started out at $300,000. Every year you amortize those down over the 15 years. So maybe now they're sitting on your books at $300,000, an amortization of $80,000. So they're $220,000. That's how you track them. Now, when you go to sell them, then you need to look and see what's really left of the ones that I originally bought and do a revaluation. But it's never going to be higher than what you paid for them, but it could affect your net book value. Again, that's something we do all the time, every day for 300 clients. If you want to call us, just like Ken said, we can show you exactly how to do it and do it correctly.
Should sellers maintain their insurance coverage as runoff, and for how long after sale? I can tell you on every deal that I do, the APA, Asset Purchase Agreement, requires the seller to maintain the insurance for at least a year. Sometimes I say 3 years, and also add the purchaser of the business as an additional insured. Mitch, you can respond to that, though.
I absolutely agree to that. And what you'll usually find, the insurance people can correct me, but I don't think they will, is that the insurance premium is minimal when you don't own the company anymore, when you sold off all your accounts and you just have the shell corporation. I have probably the smallest corporation in the smallest alarm company in the country. I've got an alarm license to keep it active. I've got my house, my office. Those are my two customers. But I have to maintain insurance, and so I went to SARG, Security America Risk Protection Group, and got a minimum policy for $700. that covers me. But if you sold your accounts and you still have the shell of your company, $700 to keep from having to call a lawyer when some customer calls you from 2 years ago that there was a bad install or something like that, or even something that's frivolous, to pay $700 a year to get that kind of insurance defense and that kind of coverage is nothing. I can't imagine anybody that wouldn't talk to their lawyer and talk to Ken and carry insurance until the statutes run out on every possible claim that anybody could make regarding that company.
I'd like to get a comment on the cost of purchasing a tail. Bart, you happen to know the answer to that? I can unmute you if you do. Although I think I should require you to put your webcam on so I can see where you're sitting, since you commented on the bed behind me. You ready, Bart? Here you go. And put your camera on, wise guy.
Okay, so Mitch is correct. The minimum policy amount would apply because the underwriting goes based on revenue. So Mitch's description of the transaction is correct.
But do you know that when I tell someone you have to continue your insurance, are they buying a tail or are they just continuing their existing policy? Do you know how the premium works for the industry?
They're continuing the policy. We call it a tail. It's just a label.
But is there any reduction in premium because they're not doing new business?
Well, Mitch answered that question in his circumstance. It goes down to the minimum policy, and I don't think we're still writing at 700. I think the minimum now is like 850.
Yeah, okay, 850 maybe. Not a big dent in my finances for the coverage it gives you to keep somebody from frivolously suing you and having to get your own lawyer.
Yeah, I mean, Mitch is absolutely right. And if you sold your business for 6 digits or 7 digits, even for mid 5 digits. I mean, let's say you sold a chunk of account, you sold your assets for 50,000. I mean, come on, 850 just to cover yourself for the 1-year policy, Ken, that's in your contracts that says, for the statute of limitations is cheap insurance.
Well, it's cheap if you're getting the minimum policy. It's not cheap if you're maybe carrying the policy for a big company, for example, 30, 40,000 a year in premium.
The new business activity is 0 on the policy.
Okay, so it would drop to the lower amount. Okay.
Yeah.
Okay. All right. Good. I'm gonna mute you now because you did not put your webcam on.
No, it's on. I had it.
I don't see it. I don't see it. Oh, Bart is a general. Oh, Eileen is letting us know we have to make you a panelist. Well, go ahead, Eileen. Make him a panelist. I want to see where he's sitting. Probably on the beach somewhere, counting all that money that's rolling in from his monitoring center. Where is he?
There it comes.
Oh, here we are. Oh, the same picture as the other day. Why don't you move to a different room?
I'm in my office.
Now look at the difference between a tax advisor and an alarm guy. One guy's got plaques covering his whole wall, and you, whatever, I don't know what you got. All right, let me just read these. Ken, thank you for doing these webinars. It really helps us small companies stay in the loop. And yes, Mitch is the guy. And Mitch, what's your full name and contact information? Come on, Dave. He's in the alarm exchange, and I mean, I promote him all the time in the emails. All right, Mitch. Eileen, put Mitch's slide back on so they could see where to find them.
Do I need to do that?
Probably at a local Starbucks somewhere. I don't know, but okay. All right, everybody. We actually wound up getting a nice turnout and running over. We're gonna be doing plenty of these webinars, especially in the next few weeks. And I want to thank you all for participating. And Bart, it's time for lunch, so get going. And Mitch, thank you. So everybody, we're going to sign off now. And thanks everybody for participating. Okay?
Stay calm, wash
Especially
your
you, Mitch. We'll be in touch.
Thanks, guys.
Bye-bye.
Bye-bye.
Bye.
Off.